Hi, and welcome back to Channel 11 News. I'm Ken Shinoda, your host. Today is Thursday, April 28th, and I'm here with portfolio managers Jeff Mayberry and Sam Lau to talk to you about commodities today. Thanks for coming in, guys.
Thanks for having us.
Hey, hey.
So it's been a great run for commodities. It's we think we've been talking about commodities at DoubleLine being a good diversifier in this inflationary environment for I think more than 2 years now, and but we've run up a lot. So kind of what now? And what do you guys think about the market? You guys have prepared some slides, so I'm going to let you guys run the show today.
Yeah, Kenny, why don't you take a couple minutes and just sit back, relax, and
I look forward to it.
You know, as we like to do on our Monday Morning Minutes podcast, Jeff, why don't you tell Kenny's listeners where we are in the market with regards to commodities right now?
That's right. So if we look at this chart here, this is the Bloomberg Commodity Index. It's a diversified index of commodities. So you have oil, you have your energy, your precious metals, industrial metals, agriculture, livestock. And you can see, as you said, Ken, look at that run up over the last couple of years off the lows, the pandemic lows. You look at that and you go, did I miss the boat? Did I miss it? Is it too late? Well, let's take a look at the longer term. And here we go back to 1999, and if you look at the scale on the right, it's a log scale. So to get back to the high of '08, you got to double from here. So even though we've run up a lot, there's still, if we kind of get back up to those previous highs, there's a long way to go in the broad commodity market.
Yeah, and I mean, when I look at this chart, going back to 1999, one thing that really jumps out at me is, look at that first decade of commodity performance from 1999 to 2008, let's just call it. And that was really what people dubbed the commodity supercycle. A lot of that growth was just driven by one single engine. That was through China. China was just entered during that period the WTO, and they're just really trying to build the industry within the country and just bring it into more of a modern society. And then look at, after the GFC with all the globalization, there's money printing going on that really supported some of the other risk assets, with the fabulous Fed money printer. That didn't necessarily help with commodities, which are more reflective of true economic growth, I would say. But you kind of had that lost decade in performance from '09, through 2019 or so. But that's caused a lot of people, to wonder if we're back in another commodity supercycle.
And it's funny because during that whole time period of commodities falling and the money printing, everyone was just so worried about the money printing creating inflation, and we got to own gold, and rates are going higher, and rates fell through that whole time period. Gold did okay for a while, but it also kind of didn't do much, right? And it seems like the things that are maybe driving it now are that we're coming out of that QE. We had a big fiscal stimulus, and then there's kind of new drivers of kind of growth that are potentially kicking in, like deglobalization, right?
Yeah, yep. Absolutely. And it's one of those things where, being able to print money, not just at the Fed, but through central banks across the world, you're able to help, the global economy come out of that global financial crisis that occurred. But this time when, Jeff and I are going to start talking about some of the supply and demand imbalances out there, commodities are real assets. You can't get a printer out for that like you can for, the Fed's Burr printer out there for money printing, right? So we'll see what happens here, but it does look like it could be the start of something that's going to be appreciating on a longer run.
Great.
Yeah, and if we look at, industrial metals, one of the subcomponents of the Bloomberg Commodity Index, you heard a lot of talk recently about nickel, copper, kind of the future of those industrial metals. And here you can see that a lot of that movement priced into the market. So here's one where you look at it and say, well, it's kind of off its recent highs, but it's close to its historic highs, in '06. So do you want to really be invested in industrial metals at this point in time? But in some future slides here, we'll get to the supply-demand dynamics of it and kind of the future growth of industrial metals and why we think it's still okay time to get in. And then if we look at these so here's four just big subcomponents: copper, nickel, zinc, and aluminum. And you can see some aluminum's off a little bit from the highs, but copper, close to its all-time highs according to these indices. Nickel, nickel, one of those commodities that's been in the news a lot for not good reasons.
Yeah.
If we want to talk about the LME, we can. Hopefully, Lau and I don't get too angry talking about it, but you can see it's off of those highs there. when the LME shut down nickel trading, but still at pretty elevated levels. But across all the industrial metal complex, still some, as you would expect, when you look at the subcomponents, they make up to the master at those types of levels. So, industrial metals at kind of close to their highs. And then precious metals, two precious metals. Let's go to the next one. Silver and gold, as you said, Ken. People buying gold for your inflation protection, but here we are, 8% inflation. There's a war going on in the world, and gold has barely moved.
Yeah.
Sam and I talk a lot about, is it the Bitcoin? Is it digital gold that's taking away those assets? But we didn't include Bitcoin because we don't consider it really a commodity. But it's not rising on this high inflation or the war either. So something's going on with gold. But it's you would expect it to be higher given kind of the current fundamental backdrop.
Yeah, it's kind of been sitting at 1900 for like ever, it seems, plus or minus.
Yeah, who isn't on their desk on their team that says it's like there's a magnet and gold just keeps getting drawn to it at the 1900 mark?
It was our gold bug, and he said it was a tractor beam, not a magnet.
Tractor beam from Mr. Mark Kimbrough there. So always appreciate his take on things there.
Energy, obviously, you're well off the highs there. Oil, even though it's at 103 today, it was up as high as 130 earlier in the year. WTI still well off the highs of 05, 06, even 08. So everyone's complaining about gas prices, and certainly here in California they're very high.
Everyone in other states should stop complaining because it's like double the price in California.
I think it's locked in at like $5.99 a gallon because that 6 just is a little bit more painful than $5.99. At least where when I drove by the gas station this morning.
Yeah, I got up to $6.99.999999 where I live out there for the premium stuff. So it's just it's definitely horrendous. But it's just crazy when you look at the range that if we were to focus on WTI crude oil. I mean, back you mentioned in 05, 06, right? It got just short of $150 a barrel, and then you go out to remember April 20th, 2020 was when it got traded negative, right? Negative $40 a barrel on the close. It's just amazing. So it's definitely volatile when you're thinking about individual commodity components, and that's why we'd like to think about commodity investments as a broader basket.
Yeah, but I mean, the one thing that's also been in the news is nat gas. If you look at that nat gas chart, I remember there was a time when people were thinking nat gas was going to go negative.
Yeah, it got down to like $1, $1, 5-8 years ago, right?
I think Mr. Gelnock was one who was like, I'm an infinite buyer at negative prices.
I guess the problem is storage, right?
Well, that you just burn it off, I guess.
Yeah.
Not good for climate, but.
That's the flaring that's going up. But it's actually, going back to that side, it's really hard to tell. But right now, just seeing, what was nat gas just a few days ago? It got up to $9 a million BTU, but I'm used to seeing nat gas in the twos, but it's really just the geopolitical conflict that's just caused some supply disruption from one of the major natural gas producers, and then also just the bout of cold weather, and it's also this idea of trying to transition into renewable energy. We had a cold 2021, and that started to impact the storage levels of nat gas back there. Remember, we had that episode where we were talking about that massive run up that we saw in the UK natural gas futures as well as the TTF out of the Netherlands for representing EU natural gas prices there. So the run-ups there have just been amazing, but you can't really see it here in the log chart, but it is a pretty big run-up that we've had from 2 to up to 9. I think we're around 7 today, but I think the highs that natural gas got pre-shale revolution was around 14 or 15 bucks a million BTU. So definitely you're seeing some cycle changes that are occurring in that space.
Then the one commodity, if you look at, or one sector, you look at livestock, off the lows, but still a long way to go, similar to the other stories, a long way to go to kind of get back up to those higher levels. And then we just got the ags, also pretty volatile. This is what we like to, or we don't like to, but this is the kind of the bad side of commodity prices going up. It costs higher costs for food and to feed the world. And so that's always when you see that kind of move, especially that kind of move over the short term, that's going to put some pressure on on the food supply across the globe.
So a lot of times, we talk about, you mentioned it first, right, Ken? It's like, why should people own commodities? It's because of the diversification aspect. And here we are off to a pretty bad start for 2022 if you're looking at your traditional asset classes. I think the S&P and the Bloomberg Barclays aggregate or the Bloomberg, I see Mayberry smiling there, the Bloomberg U.S. bond aggregate, I should say. I always want to call it the Lehman egg, but the Bloomberg U.S. bond aggregate, they're both off around 10%. They've been so at certain parts of the year so far. But when you look at this chart here, you just realize that if you're just a traditional 60-40 type of investor that's undiversified into other areas, then you're off to the worst start than you have been going back to 1988. So it's definitely been a tough year for people and their portfolios. And one of these things that we like to say is when people see their quarterly statements, if they're looking at their portfolio less frequently, which I do think people should be doing. There's a lot of tactical trading going on when people should be more buy and hold, I think. But if they look at their quarterly statements, they're in for a little bit of a shock, there. But when we look at the cross-asset space on both a month-to-date and a year-to-date basis, you see that there's not been much place to hide. It doesn't matter if you're looking at that, the S&P or the aggregate, but even within the subsectors, even on the global level, you see a whole lot of red on both of these windows of time here. You see the dollar up a little bit, but look at commodities. You've seen broad strength on the year-to-date basis across the various broad baskets of commodities, but then even many of the individual ones, individual commodities. And then on a month-to-date basis, commodities are volatile. We're seeing these, a little bit of red there, but on the whole, for the year-to-date, it just looks to be quite strong, and we do think that the strength can continue.
Yeah, we get into current events. Obviously, the big Russia-Ukraine war is a big talking point today, both on a personal level for people, and also from a commodity exporting standpoint.
Agricultural goods coming out of Ukraine, a lot of energy coming out of Russia, and also Ukraine has a component or a material that's used in semiconductor production too, right?
Right. Yeah, and fertilizers.
Yeah.
So it's looking at this chart, you can see our beloved sunflower seeds. It's over 30% of global exports are there from Russia and Ukraine. But really look at that corn and wheat and barley. Barley close to my heart for beer brewing. But it's a place where there's such a big portion of those exports, and that's why you've seen when we showed that agriculture index slide. That's why you've seen that recent run up, just because who knows how much they're going to be able to plant in Ukraine these days. I think they're coming up, this month or next month is kind of their planting season. If they can't plant, then it's going to be a huge hit to the kind of export economy there.
Yeah, and these kind of this global supply chain disruptions are hard to reroute. You can't just reroute these the shipments and the imports and the export chains quickly, and then just not having the actual ag at your disposal to trade is also another impact.
And that's why the Fed's kind of in such a bind. Like, raising rates doesn't change supply chain issues. Right. Raising rates doesn't get more grains planted. So they're just hoping and praying that you see some kind of some drop in that core goods inflation, and then maybe they can slow the economy down and get wages to stop growing, right?
Yeah.
Or they need to invent the printer where you can just print like the gloopy food like in the science fiction movies.
Yeah.
That's the new Fed printer.
That's right, the new Fed printer there. But
the Jetsons coming back, right?
Some of these times, it's given that a lot of these agricultural commodities are more global in nature. You could look to the U.S. to kind of fill in the gap. But Jason Farid just sent us this chart the other day showing that, the winter wheat in the U.S. is suffering its worst crop conditions thus far, going back, I think it was 2 decades over that period of time. So it's that's why some of the grain prices that you've been seeing, trying to get some of these substitutes where they can't come into play, is starting to affect these prices on wheat, where we've seen a significant price increase in both wheat, but also the substitute products, the corn and the soybeans as well. So, this is unfortunately having a significant.
It's the perfect storm, right?
That's right.
All these bad things happening at the same time by coincidence.
And then here, as Sam talked about earlier, nat gas from Russia. I guess my takeaway from this is there's been a little bit. Some countries have diversified a little bit away from, for the past 20 years from, something like Lithuania, which 100%, they're down to 40 or so percent. But just look at those countries and how much of their gas is, how much they depend on Russian gas imports, and you can see why, they've been a little bit hesitant to kind of agree to these sanctions on Russian energy right now, and given that nat gas chart, it's like, okay, it can still go up a lot, and we think that if the war kind of continues on, that you'll see more sanctions come on, and this is kind of the last straw, and maybe the EU will be serious when they start putting sanctions on their gas imports or energy imports.
Makes sense.
Yeah, and two countries that had just hit the news tape earlier this week were Bulgaria and Poland, and on this chart I'm seeing that Bulgaria depends on 80% of its imports from Russia for natural gas, and Poland is just over 50%, and they just got shut off by Russia, Gazprom, for natural gas imports yesterday. So on Wednesday, this past Wednesday, based for non-payment, because you recall that Russia, or Putin specifically, was calling for payments for energy to be made in rubles, and these two countries did not do it, so Russia made good on its promise and just cut them off. So these European countries are just going to really be scrambling for sources of both natural gas pipelines.
Lithuania and Romania are just thanking
they diversified
the gods that they diversified
out.
Right? I think Poland and Bulgaria said they have between a month and a half to 2 months worth of stockpiles. So we'll see in a month from now, kind of do they buckle, or is it something where they get some help from other places?
Yeah, and the next two countries, Germany and Italy, which are also around 50% of their imports for Russia, they supposedly have payments coming due in May. So we'll see if how the union part of the European Union stays together and whether it comes out intact. But this is just another event that's just going to challenge that I guess you can't really call it an experiment anymore, but this new venture that they've undergone. And so when we think about demand, right, for switching over to energy right now, when we look at driving mobility, obviously you have that demand at the pump, and part of that increase in gasoline has just been this fast recovery that we've seen in mobility through drivers since the pandemic. And this chart goes back to the point in January 2020 where it's indexed to 100, but you can see that we're well above that, and we got through it pretty quickly. I mean, I think we've noticed here, at least in LA, it's like during the pandemic, I thought I'd be able to get around a little bit quicker, but the freeways have just been packed. It feels like it just takes a lot longer. So, I guess the proof is in the pudding with this chart right here, but not just in LA, but of course in development markets, emerging markets like China, and just at the global level as well. But one area that still has to recover is this air travel, and I think that's going to be a big driver for future demand as well as we get back on board planes.
Yeah, some analysts are expecting the second quarter of 22 to have to see more air travel than the second quarter of 2019.
I don't doubt it. I don't doubt it. People are just have all that that's kind of that pent up vacation demand that people were talking about.
Pent up demand, but also business travel finally starting to kind of come back. We're doing it, right? For the first time, we didn't travel for almost 2 years, and we're all kind of getting back on the road, and
we forgot all the protocols. Forgot how when you're checking into the hotel and checking into the plane, it's all, you just lose that. If you're not doing it all the time,
I didn't realize they totally remodeled the Terminal 4 at LAX American terminal, and I parked and I walked over the bridge and I walked in, and I was used to kind of going to the TSA pre-check area, and I'm like, am I in the right terminal?
Yeah, and the parking lot's a mess too, right? It's just horrible. So we all gotten a little bit sloppy in the 2 years. We got to build up our efficiency again. But I know our travel calendars are getting lined up with actually Mayberry, and I know Kenny, you too. We got to start booking some of these tickets right here pretty soon. Right. So, but there's a lot of ways to go in terms of the recovery of air travel. So that should continue to support the growing demand for some of these energy-based products here. One of the things that also people caught in the news, and we decided to add it here because it's very relevant. This is the chart of strategic petroleum reserve inventory going back to 1982. Was it 1982? It says on the chart there. And this is something that's come in the news because President Biden said to offer some relief, hopefully, for some of this price inflation that we've seen at the pump, is to release potentially up to 180 million barrels over the course of the next half year to, let's just say, a year. And what we attempted to do here, I think Jason did a great job with this chart because I messed it up horribly. But what you have is you see that the current level of strategic petroleum reserves is around 550 million. But if you take that dropout, which is that line going down on the right-hand side of 180 million barrels, you see that we're getting back to levels that we were at 1980 when they were trying to build these inventories at the Strategic Petroleum Reserve. So it's like one of those things where if they do deplete the supply by that much, that's great. Maybe it helps prices. It hasn't quite yet, or maybe it has. Maybe we'd be at 150 bucks a barrel, who knows? But right now we're still at 100 bucks a barrel on WTI crude oil. But at some point, they're going to have to buy that back, or you would think that they would buy it back, because this was developed to help buffer supply shocks in the economy. And if you bring back to 1980 levels and you get down to, let's say, 375 million, you can't weather that much more supply shock in the global economy, let alone the U.S. economy here.
What happens if you're at that level and you get a real crisis where
that's right, exactly.
You don't have as much wiggle room there anymore. So it's to do it to kind of keep gas prices in check, I guess it politically makes sense, but from a strategic side of things, it doesn't seem that wise to kind of pare it down by that much, right?
Depleting it by more than half from the peak.
You just got me a little bit angry there, Burry, thinking about when you said politically, because typically these reserves are meant to be released during periods of national emergencies. I guess you can call this kind of an emergency as well, but the last time it was used, at least politically, fairly blatantly, was back in when I guess it would be then President Clinton was trying to support wannabe or Vice President Al Gore in his election campaign against George W. Bush at that time. But prices at the pump were a little bit high. There was no national emergency. There wasn't a war. There wasn't some natural disaster that disrupted the supply of energy. But President Clinton decided, nonetheless, to release 30 million barrels from the Strategic Reserve to hopefully help people at the pump make a better situation for Al Gore, who ended up not winning anyway. But there's times where you're supposed to release it, and there's times where you're not. But political reasons, I guess, fall into that.
But look at
camp.
the little drawdown. That's nothing.
Yeah. When you're stocked up near the 727 mark, it doesn't really matter. But 30 million. But when we start talking about 180 million, and don't forget, Jeffrey, Mayberry, we talked about in the past that a lot of the reserves are being sold forward to Asia as well to help fund the budget deficit as well. So that's a little dirty secret, and that began in 2015. And you can see it's barely been replenished, right? You get that little blip around 2020 where it got picked up. Maybe that was around that 420,
maybe
2020.
Maybe they were buying negative
oil. So so we'll see. I mean, this has to get replenished. Hopefully it's not at higher prices than we're paying now, but it does need to get there.
And here we are, looking at crude inventory. We're at I think we ran it back to 2005. There's some seasonality in these numbers, which is why we like to show them kind of on a yearly basis. And we're at multi-year lows.
And isn't it ironic because for a while we spent so much money and time developing kind of shale technology. I mean, we have the ability to pump and capacity, but just like this move and pressure to go to green energy in an ironic way is one of the reasons that we're having this energy crisis now, because all the companies stopped kind of like investing in new shale pumps and growth there. Everyone's trying to go like ESG and go green, and it takes energy to go green, right?
Yeah.
And then, but we're making less of it. So
absolutely,
and I think they're still hesitant to kind of invest, right? Because they're worried that what if oil prices drop again, right?
Yeah, so I mean, there's a couple of factors there that you brought out that are just absolutely right. I mean, one is that move towards, you create a disincentive for some of these longer run projects that are required for exploration and production of oil, but that, based on the environmental concerns, but at the same time, given that weakness that we saw in that kind of that lost decade of commodities from 2009 forward, that was marked by a period of overproduction where free cash flows were being spent to improve the future capacity for production of oil, And then, of course, that led to some of that overproduction. So in the last, let's call it 2 to 5 years, I think there's been feedback from the investor community that says, let's focus the free cash flows instead on improving shareholder value rather than exploration. So that's part of the constraint in supply. But now we're moving into this era where you are going to consume a lot more commodities in order to build out this infrastructure that's required for getting to carbon neutrality, just at the time when supply might be constrained in the future. But you know, Mayberry mentioned seasonality in this graph. It's not only the lowest point, but if you kind of squint your eyes a little bit, blur the lines a little bit, you'll see that the trend tends to go up going into the summer months, because that's when the summer build is supposed to, or the build is supposed to happen in inventories to help facilitate the summer driving months. But now it's the classic other way around, bro, that we like to talk about, where the inventories are in decline. So this makes me concerned about what oil inventories are going to look once we get into peak driving season. That's due to come just around the corner in the next few months. And there we have it. I mean, we see it right here. This is another way to look at these low inventories on the back of demand here. So right now we have the crude oil stocks to use ratio, and you can see that's at multi-year lows, and this is measured in days. Where
does not look good.
Doesn't look good at all, right? So how much we're pumping versus how much we're using is just not many days of cover right there, especially again as we're coming into this peak driving season. You also see it here with the distillate stocks, which are just derivatives of the base of crude oil. So you think about your gasoline that you're paying at the pump, your heating oil, gas oil, things of that nature, also at multi-year lows. And this is something that we hit on as well. Just we're talking about the capital expenditure that's been in decline, way down from the peak in 2014. So these kind of things ebb and flows, because these are long cycle type of investments and build out of the infrastructure. So you just can't snap your fingers and expect things to all of a sudden print out of this goo printer that Mayberry was talking about there. So it does look like we're setting up for this supply-demand imbalance, at least in U.S. energy, as well as here what we've seen is on more of a global front. You see that this is the version of strategic petroleum reserves that we have here in the U.S., but applied across the OECD countries, which I believe there's 34 countries right now, mostly developed market countries. But you can see that's also at multi-year lows going back to, let's call it 2006 or so.
Which was right before we saw a big spike in commodities then too, right?
That's right.
Right before the global financial crisis.
Yeah. So as Mayberry, rightly brought up before, it's like, what happens when the next energy shock comes through? Where are we going to get the supplies? You can't turn these things on the dime. And then as far as OPEC has been in the news, because people say, well, OPEC can just produce more oil, and that's one
print. You're about to say
print more, right? I'm starting to get that printer in my head now too.
We're too used to talking about printing over the last 10 years, right?
But yeah, the Biden administration, and in tandem with the IEA, which I think is International Energy Association, they're asking for OPEC to print more. To produce more, to pump more oil out and put it out in the system. But you can see this is as of February 2022, so it's on the lag here. But in terms of that spare capacity, which is highlighted in light blue for the non-Iranian countries there's about 2.5 barrels of spare capacity as of 2 months ago. And you throw in Iran in there, it's an additional 1.25 million of spare capacity. So all in, less than 4 million barrels that 2 months ago they could have potentially have brought into the market. And that a lot of that just has to do with maintenance of the infrastructure that they have, but then also just overall, full out capacity is always hard to maintain over an extended period of time.
So that just further highlights that, inventory is very low. If we do get into a crisis or demand picks up, there's not really that much spare capacity out there in terms of, as Sam said, people think OPEC can just pump unlimited amounts of oil, but they don't really have that much more that they can give.
Yeah.
We'll go through a few industrial metal charts, and we'll go through them pretty quickly because they all pretty much say the same thing. Here, you can see that there's estimations on here because it goes to 2025, but this is a similar story to the energy side. Copper miners really haven't been spending too much capex to kind of produce more copper. The Obviously, the green line just shows or the light blue line shows growth, but they haven't been spending either on the capex side for copper. You look
And
at
same thing. They're like, because it's so cyclical, they're worried like if we increase spending now, and all of a sudden you see a slowdown in growth or a recession, and then the prices drop. Like we've
Right,
just
then we
spent
just
money
spend-
to make more, and
And industrial metals are even more of a long
putting
cycle.
more supply into an already falling market, right?
Yeah, and it's really, it's a longer cycle market than even energy. These for copper, it goes anywhere from 10 to 20 years before you go from that thought of adding new mines to the exploration, to the build out of the mines, to the actual production and getting it out of the ground. It has a life cycle of around, let's just call it 15 years, and that's even before the refinery portion. So you can't just flip on the switch or put that power button on that Fed printer, like the Fed printer, and print these things out.
No burr for commodities.
No burr.
And here, this is old, so it's December 31st, 2020. But as Sam said, it takes a long time to ramp up. So Chile was a third of the production. Peru was 15% or 10%. And so it's you look at this and you're like, well, it's not that. It's kind of diversified across the globe, but you have two very large producers, and then in China, obviously, is one also. But it's it's pretty concentrated in terms of the top five top five producers.
It's pretty amazing. A third of the production coming out of Chile.
Strategically important resource within that country that's going under a significant change in their political regime, which is also having an impact on both the production, but then also because of some of the royalty taxes that are being applied, that's going to have an impact on the price of copper coming out of that country as well.
Yeah, and here you can see Chilean copper production. It's near its 5-year lows. Again, all these charts look very, very similar, and we didn't just cherry pick them, right? We're trying to give a breadth of commodities, and so it's a kind of a dire situation all across the board. So here we go, look at aluminum. So this is the, I guess I'd like to focus on the reddish brown part. That's the London Metals Exchange Global Stocks. You can see that it's back to 08, 07 type levels in terms of how much inventory they have there. The Shanghai's the little blue one above it. So together, pretty low.
What caused that huge spike in inventories that was around for like the global financial crisis through 16?
That was probably just, again, building out, and during that supercycle decade, they were building out mines to increase production. But again, given that lag in the production capabilities, it kind of came out at the wrong time, just right after the global financial crisis. And if you recall back for the chart that we looked at previously, there was a pretty good bounce in commodities after 09 into around 2011, 2012. But then around that time, you started to see more slowdown in areas around the world of economic growth. There's the European crisis that occurred, and then China, which had been one of the key drivers of, and the rest of emerging market countries that have been a key driver of growth leading us out of the global financial crisis, started to see some economic weakness around that time as well. So China's definitely a bigger part of the demand for commodities there.
Here we go. Again, we'll go through these quickly. Same story, zinc. The next one. So this is copper. It's a little more volatile, but certainly well below those levels you've seen. It didn't have that huge spike that you pointed out, Ken, in kind of post-financial crisis.
And the dotted line that's the average going back to 2000.
That's the average, yes. So well below average there. And then nickel. Nickel, over the very past few months has been in the news because the short squeeze going on and LME closing the markets, and you can see that with inventories that low, very easy to kind of get a short squeeze there.
I thought only GameStop got short squeezed.
Yeah, it can happen across the globe apparently. There's no way outside of that market move.
I don't recall any nickel memes coming out during that period of time, but there definitely should have been.
We missed our opportunity.
Some dude with a big shot meme or something like that. But I think over the last couple of slides, you saw that theme pretty much existing across various parts of the key commodities, I would like to say, that are instrumental in global growth. But so you're having that kind of constrained supply just at this time when we're going to probably need it most. And we talked about China being the driver of the engine of that supercycle that began in 1999 through 2009. Now I think when we're talking about is this going to be a next supercycle for commodities, you no longer have China as that primary driver, as their economy has slowed down relative to where they were in the first decade of the 2000s. But now instead you have this consortium of countries across the globe, both EM and DM countries that have signed on to this initiative to move towards cleaner energy. And as you said it earlier, that requires a lot of commodity input and natural resources to get there. You need oil in order to fuel the machinery that's going to build these infrastructure projects. You need industrial metals that's going to be required to electrify our system and take us from fossil fuel dependence onto greener energy. So we relied on an external source here over at Morgan Stanley, but they put together this nice breakout of what, again, it's a projection of but where they see the mix of energy, and I believe this is here in the U.S. going over the next 15 years or so, let's call it, or I guess it's really 13 years. But you can see that green section is the renewable green energy, right? You can see that's an ever-expanding piece of these pies going over in the next decade, especially into the 2030. It's almost, it's 40%, it's just over 40% of that pie. And I think that's a key date there because based on the initiative of the Paris Treaty, which these countries signed on to, the goal is to reduce carbon emissions by 50% by 2030. Maybe and I were just talking about it on the desk. It seems like
pretty close to 2030.
It's
pretty close to 2030. I'm not
like
sure if we're going
going
to get there,
it's
right?
Close, yeah.
Right, and then 2035 after that point is 55%. But I think the ultimate goal is to get to zero carbon emission or net neutrality. I believe they call it by 2050. So there's definitely a lot of work to be done. But you can see,
I think a lot of people underestimate how much actual dollars need to be spent to this initiative, and that could be a future growth engine for the globe.
Exactly.
Which is an inflation engine for the globe too. Gerard Bernac is a research person that we like here at DoubleLine, and I had him on Channel 11 maybe like 4 or 5 episodes ago, and there's a couple things that he talks about. He used to be a total secular stagnationist, and there's some big drivers that he talks about why he's changed his view, and I kind of agree with him on some of them. And this decarbonization is a big growth driver, and we talked about it earlier, deglobalization, like the days of kumbaya and having China make all our stuff is clearly not working, and people are going to bring those supply chains back. And then, the no more kumbaya geopolitically, defense spending is going up, and that needs energy, and that needs raw commodities to create those, the weapons and things like that as well. So I think there's not just this, but other potential drivers. Yeah, could we go into a recession because the Fed's raising rates and, this inflation is squeezing consumer demand? Yeah, but in the long run, there's a lot of new drivers of growth and inflation that I think are here that we didn't have over the last 10, 15 years, right?
And we have a chart in here that it's closer to the end that shows the projected spending, and it's pretty mind-boggling, I think, when you look at
spending for carbon.
Yes.
And carbon decarbonization.
For net zero emissions.
I mean, it's trillions and trillions, right?
that's right.
Per year. So here we look at, and obviously to the right of the dotted line is projection, but the kind of copper demand, for renewables, for solar, for wind, electric vehicles, charging points is a little bit of a added bonus to it, but just showing that as we kind of go to more clean energy, clean driving, just the demand for copper is just going, parabolic.
Yeah.
Yeah, and then we just show copper here, but again, nickel and aluminum and zinc are all probably going to follow the same trajectory as copper there, just because again, they're instrumental to this endeavor.
And this chart's been going around, or variations of this chart, but looking at a conventional or an internal combustion engine car uses anywhere from 18 to 50 pounds of copper. A hybrid EV is 85. A battery EV is 183 pounds of copper. And buses obviously have more batteries, so they take bigger or more amounts of copper. But at some point you can hopefully that the engineers come up with better batteries or more efficient batteries, and so you're not taking that 183 pounds of copper and extrapolating it out to every single vehicle sold across the globe. But certainly just that demand for copper and that amount of copper that's going to have to be used to kind of electrify the driving
Kind of makes
force.
you want to run out and buy a bunch of electric cars now before the prices go up.
It's one of these things too when you hear, not bashing on anyone, I hope, but environmentalists just say it's like, well, you got to get your clean energy car, They started driving those Priuses, which is the hybrid electric vehicle, which uses more than double the amount of copper than your internal combustion engine car. So I think if we're looking at that 18 to 49 pounds of copper, 18 pounds is probably my two-door coupe, and 49 pounds is probably my pickup, right, in terms of that range. But they're like, oh, you got to do it for the environment, right? But if you think about the amount of industrial metals that are required for each one of these cars and the strip mining that's required to tear up the ground to find these resources, and then after the battery's done and wiped out, how do you dispose of that? I question, and I don't know, but I just question which one is more environmentally friendly at the end of the day.
In the long run,
so it's hard to say.
And there's your chart. So this is the projected infrastructure spending to get to net zero emissions, and 2035, almost 3 trillion. I think it's trillion. Turn my head sideways.
Yeah, 3 trillion.
3 trillion per year to get to net zero. So you look at this: power generation, energy storage. We looked up what DACCS was, but now I can't.
I already forgot.
Now I can't remember what it is. It's a small piece anyway. Power network. So really, just looking at it, all these different components are going to require so much infrastructure spending, and this is global. And this is our last chart. We look at it. EVs as a percent, upper left, EVs as a percentage of vehicle sales, projected obviously upward, up and to the right, as you would expect.
Yep.
But really, when you look at the bottom right-hand chart, you have EVs being a big piece, but don't forget that the internal combustion engine is still a very large piece of the pie. So you don't necessarily want to, I guess our takeaway is, energy spending, oil is not going anywhere. You're still going to have all those vehicles, 1 billion vehicles driven, is still, and so you're still going to need that demand for oil in addition to the additional demand from the EVs and copper and all the industrial metals.
Yeah, it's the struggle, at least in the U.S., is the charging stations. Like, how do you get across? It's a huge country. People are used to driving a lot instead of flying, and how can you get across efficiently without having to stop every 5 hours to charge your car for 40 minutes. I got 3 little kids. I don't want to stop for 40 minutes to charge the battery.
Every time you stop, it probably is 40 minutes though anyway.
There's I think they're doing a test in, is it in Texas? Where are they doing a test of putting coils in the freeway so your car charges as you drive over it. Think about how many miles of putting that in from here to Las Vegas, right?
What
there's
happened
a lot
to
of that's another thing, infrastructure spending that I didn't touch on earlier, but that's something that's been very low in the U.S. and we've got a lot of old infrastructure that needs to be improved, and that's also positive for commodity use, positive for growth, positive for inflation, right?
Yeah, I wonder how good that's going to be for your health too, driving over spending all this time on the freeways when you got this charging units under you the entire time, right? Might as well live next to a power field while you're at it as well. So.
Well, it's all underground now, so you're living by it, you just don't know it.
Yeah, I'm still old school, I suppose. I stare at those power lines all the time, and it just makes me angry because I hear Sherman's voice in my head. Just every time he said it. He said it once, and now I just see power lines
What
everywhere.
about then causing, sickness and things like that?
No, just how it disrupts your field of sight, right?
Yeah.
So that's, of course, all me and my wife see nowadays is just we're just staring at the power lines all day long. So.
Or if you're looking at a house and the power lines are photoshopped out of the.
You can always move, man. You can always move.
Move west.
But yeah, that wraps it up. Hopefully you see a
It's
pretty
a
consistent
compelling
theme
case.
there, right?
I invest with my team in the housing market and mortgage bonds, and a lot of people, the bears, they just like to point to interest rates and say, oh, it's like a bond price. Rates are higher, home prices go down. In 2011 and 12, rates were falling, right, into the European crisis. Home prices were going down with rates.
Yep.
So, and that was really because of a lot of supply. So. One of the more powerful drivers for assets is that supply-demand imbalance, right?
Yeah.
And if you've got too much supply, not enough demand, prices go down. If you have not enough supply and even flat demand, prices can go up or stay stable, right?
That's what we like, was just like this.
Yes.
Yeah. But I mean, it came back to that original question you brought up: is it too late to get into commodities? And hopefully, I mean, through these series of charts, you've seen this consistent theme of constrained supply in a lot of these key commodities, and then this kind of captured demand, assuming that we can achieve this carbon neutrality and reducing our carbon footprint over the next few decades. You have that kind of demand that's held hostage for these commodities as well. So, yeah, commodities have run up a lot. They're just a notoriously volatile asset class. So, but for the buy and hold investor, I mean, it's a great way to diversify the portfolio. If anything, 2022 has showed you why you should own commodities and diversify out.
Well, especially given
return streams.
the charts that you guys pointed out, those supply-demand imbalances, the fact that while we're up, we're well off the highs of '07, and commodities are one of those things like sometimes they don't work for a long period of time just because of those supply-demand imbalances, but right now, with where inflation is and with the charts that you showed, it seems like it's a pretty compelling case that to own some. Most people own none.
Yes.
Correct.
Right. Most people own none. To own some, and obviously you can do it through futures and things like that, which we have some funds that do that. And do you have any kind of last minute thoughts on commodity-related stocks?
I mean, we always look at it, and it's you have that stock beta, right? That stock correlation. So even if you get a good commodity market, if the stock market's going down, those energy commodities those energy stocks are going to go down.
Yeah. Well, that's why I was complaining to my good friend who helps me manage my money, and he has me in some of those commodity stocks. And of course, in Feb when commodities were ripping, I'm like, stuff's not working, bro. Stuff's not working.
Yeah.
In the long run, it'll probably be fine, but I like to point out when stuff's down. I don't really call it when stuff's up. So
when it works, he's doing his job.
Yeah.
When it's down, he's not.
You also don't forget
fault.
you're subjected to that idiosyncratic management risk as well, right? Which is notorious within the gold miners. But also we've had some missteps in the past from some of these major oil companies as well. So I think if someone is looking at the equity market to get their commodity exposures, we like to say there's no better pure play for commodities than a futures-based strategy. But diversification. Maybe you get some of your stocks
movie about that gold mining company with Matthew McConaughey? That, if anything, that movie will make you not want to own gold miners.
I gotta look that up.
Oh, you gotta watch it. You gotta watch it. It's a good movie. Anyways, well, thanks again for coming in. Nice to see you guys in person.
Good to see you.
And good luck to everyone out there, and take a hard look at the commodity market for diversification in your portfolio. Thanks, everyone.